Let me ask you a question that's been bothering me for months. If you went to your doctor tomorrow and he told you your blood pressure was perfect, your heart rate was textbook, and you felt absolutely fine, would you believe him if he then said, but you're at high risk of a major cardiac event? Of course you wouldn't. You'd walk out of that office, find another doctor, and probably leave a bad review online. And yet that exact contradiction is what I see when I look at the U.S. economy right now. From the outside, the patient looks healthy. Unemployment is low. Consumers are still spending. The markets are humming along. Everything looks stable. But beneath that surface, beneath the skin of daily economic life, there are structural pressures building that most people simply aren't seeing. And here's what keeps me up at night. By the time the average person feels these pressures in their own wallet, by the time it shows up in the headlines and the dinner table conversations, it will already be too late to prepare. I've spent 40 years in banking. I've sat through market crashes, banking crises, sovereign debt defaults, and global panics. And if there's one thing experience sears into your memory, it's this. Economies don't collapse overnight. They don't just wake up one morning and decide to fail. Problems build slowly, quietly beneath the surface, while everyone around you is telling you everything is fine. The 2008 crisis didn't start in September when Lehman fell. It started years earlier in invisible ways, in lending standards that slowly eroded and risks that quietly accumulated, in warnings that were systematically ignored because the music was still playing and everyone was still dancing. And right now I believe we are in another one of those moments, a moment where the surface looks calm, but the tectonic plates beneath us are shifting. When I was a young banker, much younger than most of you watching this, I made a mistake that I've never forgotten. I looked at a company that had perfect numbers, growing revenues, expanding margins, happy investors. Everything on paper said buy. But I didn't dig deep enough. I didn't ask how they were financing that growth. I didn't look at the quality of their debt or what would happen if interest rates moved against them. I was young and I was impressed by the surface. A year later, that company nearly collapsed. Their debt structure was fragile. Their growth was built on borrowed money that was about to get much more expensive. I learned something that day that has guided every decision I've made since. When something looks too stable on the surface, that's exactly when you need to look underneath. Because stability attracts complacency, and complacency is the enemy of survival. So today, I want to take you underneath. I want to show you what I see when I look at the American economy from where I sit. Not as a politician trying to reassure you, not as a commentator trying to scare you, but as someone whose job is to navigate this institution through whatever comes next. And what I see are three massive structural pressures building beneath our feet. Three forces that, if ignored, don't just create a slowdown, they create the conditions for something much more serious. The first is debt. And I'm not just talking about government debt, though that's certainly part of it. I'm talking about total debt across the entire system. Government debt, corporate debt, household debt, all of it has grown dramatically over the past decade. Now look, I'm not one of these people who thinks all debt is evil. Debt used properly is what builds businesses and buys homes and creates jobs. But there's a critical distinction that most people miss. Debt is manageable when the economy is growing faster than the debt. When your income is rising faster than your payments, you can handle the load. But when debt grows faster than the economy's ability to support it year after year, you're not building a foundation anymore. You're digging a hole. And the hole we've dug as a country is deep. We've become accustomed to an economy that runs on borrowed time and borrowed money. And that adjustment, when it comes, will not be painless. The second pressure is interest rates, and this one is personal for millions of Americans in ways they don't even realize yet. For nearly 15 years, we operated in an environment of historically low interest rates, near zero in many cases. And that environment didn't just change the economy. It changed human behavior. It changed how businesses calculated risk. It changed how investors thought about returns. It changed how families thought about borrowing. When money is free, you take more of it. You stretch further. You take risks that in a normal environment you wouldn't touch. It's not greed necessarily. It's just human nature adapting to the environment it's given. But here's what happens when that environment shifts. Imagine you're a business owner. 5 years ago, you borrowed money at 3% to expand your operation. It was a smart move. It made perfect sense. Now that loan is coming due, and to refinance it, you're looking at 7 or 8%. That's not a small adjustment. That's a payment that can wipe out your entire profit margin. And when that happens across thousands of businesses, across millions of households with adjustable mortgages and variable rate debt, you're not looking at a headline anymore. You're looking at a structural drag on the entire economy. The third pressure is the one that's hardest to quantify, but potentially the most dangerous. Geopolitical fragmentation. The world is becoming less connected, not more. Supply chains are being rewritten not for efficiency, but for security. Trade relationships that took decades to build are being reconsidered. Conflicts between major powers are creating volatility in energy, in food prices, in capital flows, and when the global system becomes less predictable, economic risk increases exponentially. Not because any single event causes a collapse, but because the cumulative uncertainty makes everyone more cautious. Businesses delay investment, banks tighten lending, consumers pull back, and that caution, multiplied across 8 billion people, becomes its own kind of economic contraction. Now, I want to be very clear about something because I don't want anyone watching this to misunderstand. I am not predicting that the American economy will collapse tomorrow. I am not saying go hide your money in a mattress or stockpile canned goods. The United States remains the strongest, most resilient, most innovative economy in the history of the world. We have the deepest capital markets, the strongest rule of law, the most talented and hardworking people anywhere. But resilience is not the same thing as immunity. And no economy, not even ours, is immune to the consequences of bad policy, excessive risk, or global shocks. What concerns me most is not the problems themselves. It's the complacency. It's the assumption that because things have been stable, they will remain stable. Because when you stop asking hard questions, when you stop stress testing your assumptions, that's exactly when the system becomes most vulnerable. That's when the quiet pressures finally break the surface. This isn't some abstract economic theory I'm describing. This is happening right now in real time in boardrooms and kitchens across this country. And the most dangerous part? Most people won't feel it until it's too late. Because economic stress doesn't announce itself with sirens. It whispers. It shows up in the job offer that never comes, in the promotion that gets delayed, in the small business owner who decides not to expand this year, in the family that quietly realizes their mortgage payment is about to jump by $800 a month. By the time you feel it in your own life, the decisions that created that reality have already been made. The question isn't whether these pressures will have consequences. The question is whether you'll see them coming or get caught completely unprepared. Let me walk you through how this actually works, because understanding the mechanism is the only way to protect yourself. Start with that business owner I mentioned, the one whose loan is resetting from 3% to 8%. What does he actually do? He doesn't make a grand announcement. He doesn't call a press conference. He just quietly stops hiring. He delays that expansion he was planning. He looks at every expense line by line and starts cutting. Maybe he lays off a few people. Maybe he freezes salaries. Nothing dramatic happens on any single day, but across 1,000 businesses, across 10,000 businesses, that caution adds up. It becomes slower job growth. It becomes lower consumer spending. It becomes an economy that's running a little colder, a little weaker than the headlines suggest. And because this happens gradually, because it happens beneath the surface, most people don't connect the dots until they're personally affected. Now add the psychology of it. Humans are terrible at recognizing gradual change. We're wired to notice sudden threats, not slow-moving ones. It's why you can boil a frog by raising the temperature 1 degree at a time. The frog never notices the danger until it's too late. And that's exactly what's happening in parts of our economy right now. The water's getting hotter degree by degree, and most people are still swimming around like nothing's changed. I've seen this pattern before in the late 80s, when the savings and loan crisis built slowly over years before exploding. In 1999 and 2000, when everyone knew tech stocks were overvalued but kept buying anyway because the momentum felt permanent. In 2006 and 2007, when housing prices had clearly detached from reality, but the music hadn't stopped playing. Every single time, the pattern was the same. Gradual pressure building, warnings ignored, complacency prevailing, until suddenly the gradual becomes catastrophic. What's different this time is the complexity. We're not dealing with a single overvalued asset class or a single broken industry. We're dealing with interconnected pressures that amplify each other. High debt makes the economy more sensitive to interest rate changes. Higher rates make debt harder to service, which slows growth. Slower growth makes geopolitical shocks more damaging because there's less cushion. And all of this happens while the global system is fragmenting in ways that make traditional economic models less reliable. The old rules don't apply the same way anymore. The relationships between inflation and employment, between growth and debt, between risk and return, they're all shifting. And when the rules change, the people who get hurt worst are the ones who didn't notice the rules were changing. Put yourself in the position of an average family right now. You're hearing that the economy is strong, unemployment is low, wages are up, but your grocery bill is 30% higher than it was 3 years ago. Your car insurance has doubled. Your credit card debt is creeping up because everything costs more. You're working just as hard, maybe harder, and somehow you feel like you're falling behind. That's not a feeling. That's the structural pressure translating into daily life. That's the debt and the rates and the global uncertainty showing up at your kitchen table, and the psychological toll of that disconnect of being told everything is fine while your own experience says otherwise. That creates its own kind of economic damage. It makes people cynical. It makes them disengage. It makes them stop planning for the future because the future feels too uncertain to trust. I think about this constantly as a banker, yes, but also as a father and a grandfather. I think about young people trying to buy their first home in an environment where mortgage rates have doubled. I think about small business owners trying to keep their doors open while their loan payments eat them alive. I think about workers who see headlines about a strong job market but can't seem to find a job that pays enough to keep up with rising costs. And I think about what I would tell them if they sat in my office right now and asked me what to do. Because the easy answer, the comforting answer, would be to tell them not to worry, to tell them the system will work itself out, to tell them to just keep doing what they're doing and trust that the experts have it under control. But that answer, while reassuring, would be a disservice. Because the reality is that systems don't work themselves out. People work them out. People who saw the pressure building and made adjustments. People who refused to be complacent, people who asked the hard questions while everyone else was enjoying the music. When I was in my 20s, early in my career at American Express, I watched a very smart, very successful executive lose almost everything because he assumed the good times would last forever. He leveraged himself to the hilt. He borrowed against his future because his present was so comfortable. And when the cycle turned, when the pressures that had been building finally surfaced, he had no cushion, no margin of safety, no plan B. I never forgot that lesson, not because he was foolish, he wasn't, but because he was human. And humans are wired to project the present into the future. We assume that what's happening now will keep happening. It's the most natural cognitive bias in the world, and it's also the most dangerous one in finance, because markets and economies don't move in straight lines, they move in cycles. And the longer a cycle runs, the more people convince themselves this time is different. This time the old rules don't apply. This time we've permanently transcended the boom and bust. That belief, that seductive, comforting belief, is exactly what makes the eventual adjustment so painful. So what do we actually do about this? Not in some abstract policy sense, but in the reality of your own life, your own finances, your own future. Because I can sit here all day describing problems, and that might make for interesting conversation, but it doesn't help anyone. The value isn't in diagnosing the illness. The value is in understanding what you can do while there's still time to act. And there is still time. That's the part people miss when they hear conversations like this. They think if the economy faces serious risks, the only options are panic or paralysis. Neither is true. The truth is that between the moment problems become visible and the moment they become unavoidable, there's a window where the people who pay attention, who think clearly, who refuse to be complacent, can position themselves differently. That window is open right now. If I were sitting where you are, if I were 30 years old again trying to build something for my family, here's what I would focus on. First, I would stop trying to predict what happens next. I know that sounds counterintuitive coming from someone who just spent 20 minutes describing economic pressures, but hear me out. Predicting is a trap. It creates false confidence. It makes you think you know something you can't possibly know. I've been doing this for 4 decades, and I cannot tell you with certainty what the market will do next month or next year. Anyone who claims they can is either fooling you or fooling themselves. The goal isn't prediction. The goal is preparation. It's building a foundation strong enough to handle multiple possible futures, not just the one you hope will happen. Second, I would stress test my own life. I would sit down probably on a Saturday morning with a cup of coffee and a notebook, and I would ask myself the hard questions. If my income disappeared for 6 months, what would happen? If my largest expense increased by 20%, could I absorb it? If the value of my biggest assets declined, would I be forced to sell at the worst possible moment? These aren't pleasant questions. They're not fun to think about, but they're the questions that separate people who get destroyed by volatility from people who survive it. In banking, we call this stress testing. We run scenarios that seem unlikely, even extreme, because we know that unlikely events happen more often than probability suggests. You should do the same thing with your own finances, not because you're pessimistic, but because you're responsible. Third, I would look at debt differently. Not all debt is bad, but all debt is risk. And in an environment where the cost of debt is higher and more volatile, the risk is amplified. If you have variable rate debt, understand exactly what happens if rates go up another point or 2 points. If you're carrying credit card balances, understand that those rates are already punishing and could become more so. If you're considering taking on new debt, be brutally honest about whether you can service it in a weaker economy, not just a strong one. The cheapest debt, the safest debt, is the debt you don't take on in the first place. That sounds simple, almost too simple to matter. But the people who understand that simple truth, who live by it consistently, are the ones who sleep soundly when everyone else is lying awake worrying. Fourth, I would think about liquidity differently. Cash in normal times feels like a drag. It doesn't earn much. Inflation eats away at it. There's always pressure to put it to work, to invest it, to get it earning something. But in uncertain times, cash is oxygen. It's flexibility. It's the ability to make decisions from a position of strength rather than desperation. When the cycle turns, when markets drop, when credit tightens, the people with cash don't panic. They don't have to sell assets at fire sale prices. They don't have to make terrible decisions because they have no other options. They can wait. They can be patient. They can take advantage of opportunities that only appear when everyone else is desperate. I'm not suggesting you hoard cash under your mattress. I'm suggesting that liquidity, real liquidity that you can access without penalty, is worth more in this environment than most people realize. Fifth, and this is the most important one, I would invest in myself. Not in the cheesy motivational speaker way, but in the practical, concrete way. I would learn things that make me more adaptable. I would build skills that transfer across industries and roles. I would cultivate relationships with people who think differently than I do, who challenge my assumptions, who see risks I might miss. Because in a rapidly changing economy, the most durable asset you own isn't your house or your portfolio. It's your ability to adapt. It's your knowledge, your judgment, your network, your reputation. Those things don't get wiped out in a market crash. They don't get called by a lender. They don't lose value when interest rates rise. If anything, they become more valuable when everything else is uncertain. I think about this constantly as I watch young people starting their careers today. They're entering an economy that looks nothing like the one I entered 40 years ago. The old rules about staying with one company for 30 years and collecting a pension, those rules are gone. The new rules are still being written, and that uncertainty, that lack of clear paths and predictable outcomes, it's terrifying for some people and liberating for others. The ones who treat it as liberating, who see uncertainty as opportunity rather than threat, those are the ones who will figure it out. Not because they're smarter, but because they're more adaptable. Because they're not clinging to a specific vision of how things should be. They're paying attention to how things actually are and adjusting accordingly. When I talk to young bankers at JP Morgan, the ones who impress me most aren't necessarily the ones with the highest test scores or the most prestigious internships. They're the ones who ask good questions, the ones who challenge their own assumptions, the ones who admit when they don't know something and go find the answer. Because those habits, that intellectual humility and curiosity, those are the things that survive any environment. Markets change, industries transform, entire career paths disappear and reappear, but the ability to learn, to adapt, to think clearly under pressure, that never goes out of style. The goal of all this isn't to make you paranoid. It's not to have you living in fear of the next financial crisis or checking your portfolio every hour. That's no way to live. And frankly, it's counterproductive. The goal is to build something real, a foundation strong enough that when the ground shifts, and it will shift, you don't collapse. A margin of safety wide enough that when things go wrong, and they will go wrong, you have room to adjust. A mindset flexible enough that when the future doesn't look like you expected, and it never does, you can pivot instead of breaking. I've now been CEO of JP Morgan Chase for nearly 2 decades. I've seen booms and busts, crises and recoveries, moments of irrational exuberance, and periods of unjustified despair. And if there's one thing I've learned that I hope stays with you long after this conversation, it's this. Economic strength isn't about never facing difficulty. It's about having the capacity to absorb difficulty and keep moving forward. That's true for countries, it's true for companies, and it's absolutely true for individuals. The goal isn't to build a life that never gets tested. The goal is to build a life that can withstand the test. So don't be the person who assumes the music will keep playing forever. Don't be the person who ignores the pressure building beneath the surface because it's easier to focus on today. Be the person who pays attention, who asks the hard questions, who builds a foundation strong enough for whatever comes next, not because you're pessimistic, but because you're responsible, not because you expect disaster, but because you respect reality. The economy will have its challenges. It always has. It always will. But the people who understand that, who prepare for it without being paralyzed by it, those are the people who don't just survive the difficult times. They're the ones who build something lasting through them. Thank you for listening. Thank you for caring enough about your future to spend this time thinking about things that aren't always comfortable to think about. That willingness to face reality, to engage with complexity, to refuse complacency, that's more valuable than any market prediction or investment tip I could give you. Hold on to it, use it, and whatever comes next, face it with your eyes